Hi everybody, and welcome to a brand new episode on my channel. Today we're going to talk about investing. As you know, the channel is focused on investing, on personal finance, and the means for you to get to be financially independent. Today I'd like to start the topic of investment, and I really want to offer you 5 considerations before you actually put your money on the market. So let me provide some context. I really want to distinguish the day trading from investing because those to me are completely different things. Day trading is what you see typically on movies, in watching certain channels on TV where people are trying to pick the best stock. They're trying to sell certain stocks which are supposedly not going to do well. And those people are stockbrokers, people who make their living by buying and selling stocks on a day-to-day basis. And that's fine, but I really believe that this is completely different than what wants to do as they consider investing. To me, investing is something that you want to commit to long term, that's going to ultimately increase your kind of wealth with the amount that the stock market is growing. So let me give you an example. If a stockbroker says today, let's say Amazon is down, buy Amazon today because tomorrow it's going to be $100 more and tomorrow you can sell it and make $100 profit on each stock. Now that may be true, but that's basically speculation. We have no evidence that that's going to happen. I can't predict the future, and I guarantee you that you will not be able to predict the future, even though it's very likely that Amazon is going to go up in value. But when I talk about investing, what I really encourage you to think about is something long term. And that's my first tip for today. Think of investing as a long-term strategy. So typically people that want to invest their money, they want to grow them with time, and usually their horizon is anywhere around 5 or 10 or 15 years, even longer, 30 years, 40 years from now. In fact, more people think about investing in their early ages because they want to retire well, or they want to retire early. So they're looking at least 10, 20 years of investment, if not more. Now, if you want to basically invest any money that you've saved so far and you want to put it in the market because, let's say, things look good, the market is growing, somebody told you or you heard you're going to make some money, that may be true. But if you need the money that you have, that you've planned to invest in the next 5 years, I would basically discourage you from putting the money on the market. It is risky, you may lose the money, and you may end up in a worse situation. So my rule of thumb is, if you need the money in the next 5 years, don't invest it. I wouldn't bother. Now, if you're talking about anything longer term, then yes, absolutely yes. It's a good way to use compound interest and leverage basically the big companies in the stock market to make you money. Now, the second tip I want to give you as you think about starting to invest, that is really to think about, okay, what is the money that I have for investing? Is it something that I owe, that I've saved, or is it money that I can get so I can invest? And let me clarify this. Some people, maybe they're not ready to invest, but there's online brokers, there's banks, there's all sorts of credit ways to get money. And they encourage you, if you don't have the money now, you can still invest. Kind of true, but you're setting yourself for disaster because you can borrow money and then invest it. But if you lose from your investments, or you make a mistake, you make a poor call when it comes to investing, because maybe you're still learning, or maybe you're overconfident, whatever the case is, you may lose that money, then you would owe a lot more money to the person or institution that lent you that money. And that's not a situation you want to be in. So my second tip is to only invest money that you actually have accumulated, and that is your own money, your own savings. Speaking of savings, in order for you to be able to invest on a regular basis, again, what you want to be doing is you want to be saving on a regular basis. So as long as you're saving regularly, as long as you're putting money aside for investing, then you will never have to think about, borrowing money from somebody else in order to invest, because, hey, you want to make some money off the market. My third tip for you regarding investing, as you're starting out especially, is to always think about when I'm going to need cash. Because it's easy sometimes people, they want to invest, they've got this urge to start making money from the market, but maybe they're not ready yet, or maybe their job is kind of risky, they may lose their job, and then all kinds of financial struggles happen. So my advice is, as my third tip for today, is for you to establish an emergency fund. And to be honest, that is the best thing that you can do prior to starting to invest, regardless if you're going to invest or not. It's a good general practice from a personal finance perspective. And the rule of thumb is that you want to have maybe saved at least several months of your kind of monthly expenses into an emergency fund, so that you can use it should anything happen. Now, if you're young, in your early 20s, if you're single, no kids, no family, no dependents basically, you can probably get away with saving about 2 or 3 months of your expenses, and that's going to be sufficient for your emergency fund. However, if you've got dependents, if you've got maybe kids, or maybe you're married and you have some other things that people are depending on you and on your salary, then what you want to be thinking about is maybe a little bit longer than 3 months. Probably you want to set aside money for anywhere between 3 to 6 months of expenses, so that should anything happen, you don't need to go back and dig out and kind of like sell your stocks that you bought that you want to invest long term. Typically, people don't have that practice to establish an emergency fund, but it's a really, really good thing to have. And just so there is no confusion, when I mention kind of the term emergency fund, it's not a fund that you buy, it's not a fund that you invest in or anything like that. It's basically savings that you've put aside, and you don't touch those savings unless something bad happens. So maybe, I don't know, you need to go to the hospital, you lost your job, you can't pay your rent, things like that. So that's the only time you would be kind of going back to the emergency fund, or money that's set aside to cover your expenses, which are usually something of kind of an unforeseen event. Now, once you have the emergency fund, then you actually can afford to invest, and kind of rest assured that you'll be less prone to having to dig into investments to, when you need cash. Now, as you think about investing also, my tip number 4 for today is to also to understand how risk averse are you. Because the reality is, investing in the stock market actually is a risky thing. There is no guarantee that you'll be making money. There's no guarantee that your money will double, triple, quadruple. It's a very likely event for your money to grow, but there is no guarantee. And to be honest, I think the shorter you put your money in the market, the more likely you are that you're going to lose that money, because there are swings in the market very often, and if you're not, let's say if you're just starting out, it's easy to make the mistake of pulling out. And in fact, that's the worst thing that you can do, because you're going to lose your money. So think about how risk tolerant are you, and that's going to help you also decide how much money you're willing to kind of bet on the market. And it's not necessarily as risky bet as if you go to the casino and you try to play blackjack or whatever. It's much lower risk, and in the end, if you stay longer, the likelihood is that you, in the market, you will make money. Unlike if you stay longer in the casino, the likelihood is that you're going to lose your money because the house always wins. But think about how risk tolerant are you, because it's important to be realistic. If you're a very risk averse person, then you can deploy different strategies or focus on funds in the stock market which are less risky. And there's plenty of options for that. If you're a riskier person, you like a higher reward, you want to make more money, then you can choose riskier assets. Now, everybody can be very confident and they can say, well, yes, of course, I can take some risk, no problem. But it's important to be very realistic about it. And what I would like to recommend to you is there is a lot of sort of questionnaires and quizzes online that you can do to determine your kind of risk tolerance. My next final tip, actually, my fifth tip for today, as you think about how much you're willing to risk to invest in the stock market, is actually to think about or accept rather the fact that you will lose money at some point while investing. And let me give you a little bit of details on this. So you may or may not know, but there is usually a downtrend for the market, which is usually called a bear market, meaning the market is losing money, it's going down, things look crazy, lots of people losing money on their investments. And then there's the opposite positive events that can take in with the market, which is the market is going up, or we have a bull market, which means stocks are, doing well, people are making money, people are kind of getting very good gains on their investments. And the reality is that both of those downtrends and uptrends, they follow each other. And when I say be prepared that you're going to lose money on the market, it's just a matter of when. What I'd like to stress is that there is always going to be a bear market and a bull market. Traditionally and historically, rather, the bull markets have lasted longer than the bear markets. That's why when the market goes down, maybe that takes about a year or so, or 9 months to a year and a half. People will be losing money, people will be pulling out of the markets, which is a big mistake. And then after that, we've got, let's say, 5, 6, 7, 10 years of a bull market, such as what happened in the recent years. And then the market is growing and you're actually making huge gains. For example, the market crisis around 2008, 2009, that was a pretty big bear market. It was pretty disastrous. It looked pretty bad. However, since then, it's been already 10 years, the market has been doing fantastic. We've got a huge uptrend. People have made all the money way back, and they've made quite a lot actually since then. So my point is, you need to be mentally prepared that it is okay at some point for your portfolio to be going down. That's the natural turn of events, and that's the natural kind of course of investing. And to give you some statistics, historically, I believe, don't quote me on the exact ratio, but bear markets to bull markets is usually kind of like a 1 to 3 ratio, where for every bear market you've got about 3 times longer or more of bull markets. That is, the market is going up. So at any rate, if you're looking at a longer time horizon, as I mentioned from the very beginning, you want to look at things like 10 years, 20 years, 30 years from now as you're investing your money, then for that duration, the likelihood is that your money will grow quite significantly. In fact, the statistic is that if you put your money into something like a S&P 500, which is the index of the 500 biggest companies in the United States, that your money will pretty much double every about 9 or 10 years. Because through compound interest and kind of like getting also some dividends from the stocks while buying S&P 500, you basically are gaining a little bit every year, and then within the matter of 10 years, say you invested $10,000, at the end of those 10 years, your money will likely be somewhere around $20,000. Now, it's not an exact science, there's nothing that's certain, but historically the S&P 500 as an index has returned anywhere around 7 or 8 or 9%, so anywhere in between those. So if we think about 30 years, and if you assume that your money will double every 10, an initial investment of $10,000, in 10 years that will be 20, in another 10 years that will be 40, and in another 10 years that will be $80,000. You know, if you're not contributing and if you're not adding more money to investments. So as you can see, play around with the compound interest to, you know, if you don't know, to understand how it affects your portfolio. But that's really the best thing that you can do with your money. It's significantly better than simply keeping your money under a mattress or keeping it in a CD. Keeping it in a CD is fine. You can probably make 2.5% maybe. That could be okay. It's very good actually to use a CD or some sort of a savings account with a decent percent of, let's say, 1% or 2%. That's good for your emergency fund, because if you have to take money from your emergency fund because you need the cash, the worst thing that can happen is to lose that 1 or 2% of interest, which is probably not a lot anyway. So from the stock market though, you get significantly higher gains with some risk, but if you wait it out, if you wait long enough, you can reap the benefits. And if you want a little bit more kind of convincing data, what I would encourage you again, if you go on Google and type S&P 500 index, and if you look at how it has been doing historically, what you will see is that there is a lot of where the S&P 500 is going up, then is a downtrend. That's usually some sort of a financial crisis, and then that lasts for some months or a year, and then there's uptrend, so it makes up all the money again, and it's going even higher, then lower, etc. But if you look, I believe there is data available for the last maybe 50 or 70 years, and you'll see that your money ultimately grows. So with that, I think I'll wrap it up for today's episode. I hope those tips were useful, and we're going to talk a lot more about investing, a lot more in depth, and we're going to cover all those topics to help you out to become a successful investor and ultimately reach your financial freedom. My name is Kurt, and it was a pleasure. I will see you in the next episode.